Hi guys, so today July 30th and we do have just a quick video here. We're gonna understand what is the balance sheet. So first we start with this nice chart. So this is the Fed fund rate. This is the interest rate of the Federal Reserve Bank of America. Then we do have the USD index. Okay, this is the fund. It was at like 6.5 in 2001. Everything was good. Then they started dropping it to almost 1%. Then they did get back in 2004. They did increase it back to 5.3 in 2006. They continued like that. Then we did have the recession in 2007. Everything started going down. So they do have to drop the interest rate a lot, and they started what's called the quantitative easing, or the Feds call it large scale asset purchases. What this is, quantitative easing, also known as a large scale asset purchases. So just the Feds, they will go out and they start buying assets. So they create money, they make money through the money machine, and they go and they buy like assets from the financial institution, commercial banks, stuff like that. So quantitative easing, also known as large scale asset purchase, is a monetary policy whereby a central bank buys predetermined amount of government bonds. And pay attention, when they do buy the government bonds, they have a limit, because every time they buy it and there is like a demand for it, the interest rate will go down. So once the interest rate does drop to zero, they can no longer use this method or other financial assets in order to inject liquidity directly into the economy. Okay, so once they finish with buying the bonds, so this is quantitative easing. When economy in recession, what does central bank do? First, they lower the interest rate to make the cost of money borrowing is cheaper. So when the companies, they want to make new factories, then they don't have money, so they need to borrow money. If borrowing the money is very expensive, those companies can't borrow the money, is too expensive for them. But if the central bank does drop the interest rate, then it will be easy for the company to go get money, and instead of getting $100,000 and paying back 120, he will pay back 15. So by this way, it's cheaper for him to take money and give it back. So this will make the company build a new factory, hire new people, make new product. So here there was like almost only 1 billion. If we take this line, was like that, and start jumping like this, like that. And in 2014, they did stop buying, and they did continue like this. And 2018, they're starting actually selling. Okay. So at that time, they determined the economy was good enough, they don't have to buy anymore. Okay. So here the economy was good and they didn't have to buy anymore. At that time, they actually said, we are going to sell a little bit. We need to slow down this. Why they are selling it? Because they want to have the credit back. So in the future, if we do have another recession, they will be able to buy. But if they already buying too much and they have a recession, they can't, take measurement. They have like almost bought everything, they can no longer buy, so they will be like hand tight. So they want to sell it back, so in the future, if they want to buy it, they can buy it and boost the economy. So that's why they're playing with this. Okay, so the first thing the Feds play with is the interest rate, which is this one, this line here. Okay, this is the interest rate they play with. First one, they dropped it. And the second thing they did play with is the larger scale asset purchase. So they boost money to the economy. So they made borrowing money so easy from the banks, it's almost close to zero, and they made the liquidity in the banks also very available. They bump the money to the banks. They create money and they go out and they start buying so much assets, and they make the money so available to the banks, so the companies can start borrowing money and taking money easily. Okay, so those are the two things. And at that time, they started, when they figured out the economy is good, and the inflation, of course, at that time was dropped so bad. So when the inflation started to pick up and the unemployment rate start, getting to good numbers, and the economy is doing really good, so they started increasing rate at that time. Okay, and here they stopped buying bonds. They stopped buying larger scale asset purchase, and at that time they actually started to sell off. Okay, but slowly. They're not selling fast, they're selling very slow. okay, for determine amount of selling. Okay, let's see how did this affect the dollar index. This orange line is the dollar index. You can see the dollar index was 118, really high here in 2001, and start getting down as the interest rate was dropped. Okay, when the interest rate started picking up here, the dollar down did continue going down. At that time in 2007, they did have a recession, and they're starting dropping interest rate. You can see it was dropping the interest rate so much, the dollar index did just grow up a little bit. And also one of the reasons for this, because they stimulate, they start buying and injecting money to the economy, and this kind of boosts the stock market, but also it makes a little bit of weakness to the dollar itself. Okay, they're supposed when they drop the interest rate, the dollar becomes more favorable and start buying the dollar. But because at the same time, so this is positive for the dollar and this is negative for the dollar. So when the dollar index is supposed to go up by doing this, at the same time they are doing that. Okay, so you can see the dollar index did pick up a little bit because the interest rate dropped, and the economy started to grow, getting better a little bit slowly, and at that time, you know, start ranging at that area. But in 2016, in 2014, when they stopped the stimulation here, they stopped the purchase of a large scale asset purchase. They stopped that. So you can see the dollar index did go up from 81 to 101. Okay, when they start to, okay, then the dollar index starts coming down, you know, a little bit. Pay attention also at the same time they were increasing interest rate, so they did put this on hold. They're no longer buying assets, and they also increasing interest rate. So this is giving strength to the dollar, and this also slowing down this or stopping this is giving strength to the dollar. So you can see the dollar index did increase at that time. Very clear, okay? So if you look down, then the interest rate was increasing, this positive for the dollar, and this also stopped, this also being positive for the dollar. So the dollar did surge a lot from 81 to 100. So the dollar did get very strong against majority of other pairs. Okay, at that time they start to slowing down this. Okay, they start slowing down in this area. Actually they're selling it off. You can see the dollar index came down a little bit and start, you know, here and there. What the Feds are gonna do now, they are going to decrease the interest rate. They're going to slow down this tapering line. So what does this mean, slow down? Make reduction. So here, how this line is going like that, there's a certain amount of selling the assets every month. They would slow this down. So instead of this line going in this degree, it's gonna go down in that degree. So instead of selling, let's say 50 million every month, they only sell 15. Instead of selling 15, they will only sell 10. So they will slow down the sale of this purchase. So they are actually boosting the economy. So they are going back to something like here. So they see the economy, they are afraid the economy is gonna do bad. So they start to increase in interest rate. Okay, and instead of buying like bonds and stuff, they're gonna start slowing down the selling. Okay, so now this will bring us to two terms. The first one, tapering, and the second one is reduction. Okay, let's go understand this one. So what is tapering and what is reduction? Okay guys, so what is tapering and what is reduction? So we said they start in 2008, they start buying like bonds and large scale asset purchases. Okay, so they are going in a scale, so every month they buy a certain amount, and they came to a certain time and they said we need to slow down this, slowing down the amount they buy monthly. What this called is tapering. So they're slowing down the acceleration speed. So it's like you're going in a car in 100 km per hour. Okay, then You said you're accelerating, you're going from 0 to 100. In every minute you increase 10 kilometers. But you came after the 6th minute, you start saying, I'm gonna increase only 5 kilometers per hour, I'm not gonna increase 6 kilometers. So you're still going forward, you're still traveling forward, not backward, but at a slower acceleration, okay? So your speed is slowing down, but you're still going forward. So that's what the Fed did. They did tapering. Tapering is, instead of going at the same monthly amount they buy purchase per month, they did decrease this amount till they came to a point when they actually stopped buying, and they kept this $4.5 billion amount, okay? And 2017, this 2017, 3 years no action. In 2017 they said we want to do a reduction actually is selling, okay? So tapering is slowing down buying, reduction is selling. How does this affect the market? You have to know is buying will bump too much money to the economy, so this will be really good for the stock market. So at that time the stock market was actually going like crazy because they make money is so available, and the companies borrow money. Also when they buy stuff, then they it's just like a product has been bought so much, then the value of this product will increase. That's why the stock market started doing really good and start growing. When they stop here, the economy itself was still going, so the stock market is actually doing good. When they did start the reduction, you would think that the stock market will crash. No, because they're smart, they're not doing reduction at so much level, they're doing a little bit, just a small amount, okay? And actually after they did a small amount, they said, oh no, we're selling so fast, we need to do reduction. What's a reduction? And instead of selling, let's say 50 million, instead of selling so much every month, they will sell less. So this is a reduction. This is the rate they're supposed to go, so they're going backward. They're going backward fast, they start to going backward slow. This is reduction and this is tapering. Okay guys, so why did the Fed start tapering then reduction? So we have said tapering, they're slowing down the purchase amount every month because they found the economy is good, they don't need to go that fast, okay? After they have seen that the economy starts doing good, the unemployment rate dropping, the inflation rate is picking up, everything is going as expected, they're going to achieve the target they want, then they said there is no need to buy so much stuff and make the money so available. It does also have a side effect in the long term. So they did do tapering, and they did stop in 2014 and 2016. At the end of 2016, 2017, they start doing reduction. So they will make the money available afterwards if they do have another recession. So that's why they do have a reduction, okay? And that's why they do have tapering. So you have to know both terms. So when they talk about tapering and when they talk about reduction. So what do you expect from the Fed today? We do expect them to drop the rate by 0.25, and we do expect them to do reduction. They slow down the amount of assets and bonds they sell per month. So both of those things will make money more available, and they will boost the economy, and the stock market will pick up. But the dollar index, it may not fall as everybody expecting. It may just get some volatility but not really fall. What's gonna make it fall? If they open the door in the press meeting after the cash rate for further cuts, they're gonna say we're gonna have more cuts coming. If they do have more cuts coming, like 2 more, then this word is gonna make the dollar index fall. How would today's decision affect the market? So if they do reduction in the balance sheet, this will boost the stock market very good, like will make a huge boost to the stock market. So the Dow Jones and SPX and Nasdaq and the Asian markets, all of these markets are gonna pick up, and probably the DAX, it's just gonna affect everything. So the stock market is gonna start to rallying a lot, big time, and most likely that's what is expected. Of course, we know the oil is related to the stock market a lot, so the oil probably is gonna fly with the stock market. Canadian dollar is affected by the oil, so the Canadian dollar is expected to get strong also with this, okay? You can see the dollar in this chart. You can see the dollar in this chart at the top here. This is the dollar, and this is the Euro, Japanese yen, Australian, New Zealand index. So you can see everything is down here, and the dollar is really, really strong. So what Mr. Trump wants to happen is the dollar start getting really weak. He wants to drop the value of the dollar, makes it weak. Okay, we can pay attention to the other central banks around the world. They start like easing, and the interest rate is not as high as the Fed's, so they're all of them down. Okay, and the USD index is very high, so we need to see those ones getting up and the dollar index getting down, so we can see the Australian dollar, New Zealand dollar getting up, you know, gaining, then USD CAD, USD franc, USD Japanese yen coming down. This what could happen in the market, and stock market is gonna get up, and the dollar index against all these currencies is gonna come down. Okay, so US monetary policy compared to the rest of the world, the US interest rate is the highest. It's very high. It's 2.5. Everybody else is just like really down. Like in Canada 1.75, Australia, New Zealand like 1.251, and Japan is like, and Switzerland in negative, like the Eurozone around the zero, and the yuan is just to play between the 0.5, like that. England is like 0.75. So the US interest rate is the highest. So they want to drop this interest rate to kind of match a little bit the other central banks. Okay, so we can expect that what Mr. Trump has been asking for the dollar to drop and not be very powerful would happen. How can a forex trader benefit from this? So we can take a chance of that, but this is very risky, playing the game, playing the news. Very risky. Okay, so you have to be very careful, aware of the risk. How can we benefit from this? We can go and buy stock before the decision. We can go and buy the Dow Jones. This most likely is gonna fly up. Okay, then we can go and we short the dollar, but pay attention at the beginning, the dollar may go up. Then afterwards, at the press conference, if Mr. Powell would announce that the door is open for more cuts to come soon, then the dollar is just gonna come down. So pay attention to this. We may see the dollar first going up, then afterwards coming down. Thanks guys. Please, if you do like the video, share it, hit the like, and subscribe to the channel if you didn't. Thanks a lot and have a great day.